Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Joining us now to discuss is Mohamed El-Erian of Queen's College, Cambridge. Mohamed, welcome to the programme, sir. I'm going to start yesterday. Going to go back to yesterday morning, 8:30 Eastern Time, CPI drops. We were looking for you and you weren't here. You're with us now. What's your response to that data, Mohamed? Because at the moment, the market is slowly gravitating to paying more attention to levels. The Federal Reserve at the moment seems to be more, I would say, gripped by the current trend and encouraged by it. What are you focused on?
So, John, sorry I wasn't with you yesterday. I was on the road. What I'm focused on is actually summarized really well by John Authors of Bloomberg Opinion. I'm a big fan of his daily note, and today is a very thoughtful note. And he basically leaves you with three messages. One is the fall in inflation is stalling. Two, if you look at the components, they suggest that it will continue to stall. And three is that if you look at the work that's being done in the different groups of economists within the Fed, they also confirm that we've got a 3% inflation rate. Now, as you know, I think the equilibrium inflation rate for this country is between 2.5 and 3. If you continue to target 2%, then you're going to have some really difficult choices. And I think that is what's facing the Fed right now.
Do you think they're also slowly realizing, Mohamed, with that in mind, that they're not actually as restrictive as they think they are? And are you seeing evidence of that start to creep into some of the speeches you're hearing from Fed officials?
Yeah, I think they're backing away from the view that they expressed in their last meeting. And I think that what we're getting is, you know what, maybe I can live with 2% plus for a while. Because otherwise, they are in a really difficult situation. Look, the market was relieved because the market didn't look at the fact that core inflation is stuck at 0.3 monthly for the third straight month. The market was worried that the numbers would be higher than the consensus forecast, and that didn't happen.
In the components, though, the BLS reported that over half of the inflation we saw, Mohamed, came from shelter prices raising. Claudia Sahm said we don't have an inflation problem now. We have a housing problem, and that's been true for over a year. We've seen the Fed cut rates and mortgages move higher. Mohamed, how do you solve an inflation problem if it's underpinned by a fickle housing market?
So I don't think that's the only issue, Danny, but it's an important issue. And again, I'll point you to John Author's note. You can tell I really like it because he does such good detailed work.
We love John too.
Where he looks at trimmed measures, where he looks at all that. The problem is services. And within services is wages. It's a good thing for the average American that real wages are growing by more than 1% now. That's a good thing, but it's feeding into services. And that's the big issue. And it's happening at a time when grocery inflation has come down a lot, where there are negative price increases for certain food items. And the concern is that services aren't going to come down fast enough inflation-wise before goods inflation starts going up.
Mohamed, if we're going to be in an environment where trade potentially is the priority of this White House, tariffs are put on, and American companies abroad are forced to come back, and they're forced to pay American workers, is this problem not going to get a whole lot worse?
Yeah, so I'm in the UK here, Danny, where everybody, the companies have found it totally normal to say the minute my costs go up, I'm going to pass it on. And you hear that over and over again from companies in reaction to the budget. So there is this mentality right now in the corporate world that forget about your profits, forget about all the dividends and all the share buybacks you do. If your costs go up, then you should pass it on to the consumer. So there is that risk. But I want to stress that it's really hard to model what the president-elect's economic promises. First, you have to decide how many are going to be implemented. And then you have to decide the two counterforces. Yes, tariffs are inflationary. Yes, higher budget deficit will tend to put pressure. But on the other side, you have a major deregulation. And on the other side, you have a major promise to act on the expenditure side of the budget. So when you look at these two things, the first, even when you try to net it out, it's not clear. And then the second round effects get really complicated. And I tell people, regardless of what happens, we now have an inflation that's not going to go to 2%. Now, before you jump immediately to what's going to happen next, understand that you got to wait because it's really complicated economics sorting all this out.
Mohamed, you have a new piece out today, and you say, once again, it was the economy stupid in Project Syndicate. And I think, and you can tell us here, are you trying to answer a question that our own colleague Craig Torres asked Jay Powell in the press conference, which was, did you learn anything about Americans think about the economy from the election results?
Yeah, and Marie, it's fascinating because there were two economic messages sent, and they're both correct. There was the one that the Republicans pounced on, repeating the 1980 Reagan question, are you better off? And they were talking about the price level. And people really still have sticker shock when they go to the grocery store. So that is what the average person focused on.
Well, you asked a question as well in your piece. Will the Democrats and establishment, in quotes you put, experts, get the message? Will they?
Well, they haven't so far because they're focused on the economic exceptionalism, which is also true. But in a K-shaped economy, that doesn't trickle down as much as you'd like it to. So the Democrats stuck with the economic exceptionalism. They didn't understand that that message wasn't getting through for good reason because people were concerned about the price level. And you know, Anne-Marie, that the more you tell somebody a message that doesn't speak to their reality, the more they question you, the more they lose trust in you. And the economists did a terrible job, the mainstream economists did a terrible job of trying to reconcile the two views, which are reconcilable. But unfortunately, the reality is that people will continue to focus on the price level because it has been such a large shock. We're not used to seeing inflation at 9%, which is where it was in June 2022, and that impact hasn't gone away.
Mohamed, what are your thoughts on the price action? Let's talk about that a little bit. Ahead of the election, you were looking at what was happening in the bond market and the high yields, and this line came up in your Bloomberg opinion column. While most analysts agree on the list of potential contributors to this unusual development, the Fed's cutting interest rates, yields are rising, there is little consensus on their relative importance. You went on to say that over the next week, we should get some clarity on that. Do you have clarity now on what is driving long rates?
I have more clarity on what's driving long rates, and it's exactly what you have been talking about. The market is front-running economic announcements, including who's going to be in Treasury, and that's going to be really important. And I agree with Anne-Marie earlier today, saying that that really matters. You see that the economy has continued to surprise on the upside, and that has had an impact. Meanwhile, in Europe, and I'm glad you've been focusing on the FX situation, things have gone in the opposite direction. John, the yield differential between 10-year treasuries and 10-year German government bonds, the Bunds, are back over 200 basis points. That's been a massive move. And the market has understood that divergence is a major story going forward.
Mohamed, how much more divergence could things possibly get? We've already seen aggressive widening over the past week. I was mentioning in a conversation earlier this morning that the front end, if you compare the German 2-year to the US 2-year, only back in September, that was trading around 130. Now it's up like 220. So almost a 100 basis point move on that spread, Mohamed. How much wider can things get?
I think they can get wider, John. I think, if you look at the good, the bad, and the ugly of the global economy, unfortunately, Europe is in the ugly. Cyclically, they're challenged. Secularly, they're challenged. There is no definitive political leadership in the two countries where you need it most, Germany and France. There's a roadmap, the Draghi report, but they're nowhere near even talking about implementation, let alone implementation. And these dynamics today mean that if you're lagging, you are likely to lag even more. So, John, it wouldn't surprise me if you see that differential go higher. It wouldn't surprise me if you see the euro go weaker.
So that makes it easier, relatively speaking, to call the ECB for 2025. They're going to cut interest rates. Mohamed, there is overwhelming consensus the Fed reduces rates again in December. I would love your base case for 2025 before we get to the end of the year, how you're thinking about how much work this Fed can actually do, and whether you think ultimately, just in terms of how the communication has evolved over the past few days, we're setting ourselves up for a pause into 25.
So first, I agree with you that we are likely to see another 25 basis points cut in December, and we should see another 25 basis point cut. Longer term, the range, if you look at the dots of where's the terminal rate, where from about 3.5 to just over, from 2.25 to just over 3.75. And I've argued it's towards the upper end. I suspect that now is about 4%. That is the terminal rate for where we're going. So we will have a couple more cuts, and then it gets really hard to cut more, unless you're willing to have the difficult discussions. And this is not a Fed that's willing to have a difficult discussion. This is a Fed that will continue to stand behind this notion of data dependency. And this is a Fed that may be bailed out on inflation by what's happening away from it, and bailed out in the wrong way, meaning that inflation doesn't go to 2%, and they'll just say it's not our fault.
Mohamed, I could talk to you all day. We all could. What do you mean by the difficult discussion? What is the discussion that you'd like the Federal Reserve to have as soon as today? What would you like to hear from Chairman Powell at 3 p.m. Eastern time that you're not expecting to hear?
So I'm definitely not expecting to hear the question, is 2% still the right inflation target? He's not going to touch this. Hopefully behind closed doors they are, because even if you don't want to change your inflation target, and they won't change the inflation target, the path to that really matters. So I'm hoping that they're having a discussion. What is the right neutral rate in this economy right now? What is the right inflation target? That discussion, if you had it without the historical context, and without the legacy of having missed so badly on your inflation target since 2021, it's more between 2.5 and 3, and that's probably the range it should be. But that's not a discussion that he will ever have publicly, not this Fed.
Mohamed, it's good to hear from you, sir. Appreciate your time. Mohamed El-Erian there of Queen's College, Cambridge. Thank you, sir. President-elect Donald Trump's priorities coming into sharper focus. Rob Casey of Signum Global Advisors saying, we believe President-elect Trump and trade advisor Robert Lighthizer are committed to implementing an aggressive tariff agenda, likely beginning with Europe and ending with China. Rob joins us now for more. Rob, good morning.
Hey, John.
The sequence, it's a big focus for financial market participants worldwide. You think that it's going to start with trade and it will start with Europe. Why?
Yeah, well, first and foremost, it's not to say that we don't think that they're not going to wait on China for very long. But we do think that Europe is the day one priority, mostly, speaking very bluntly, because we don't think Trump likes Europe a whole lot. And essentially, we're dealing with what is not a net neutral landscape, but a net negative landscape. CBAM, deforestation, steel, Airbus, there are all of these tripwires that, the pro-EU presidency of Joe Biden was not able to deal with, was not able to handle. We think Trump comes into office essentially with all of those tripwires laid out, not really looking to avoid them.
Ron DeSantis, the governor of Florida, is in Italy right now on a trade mission. Who do you think Trump views as someone he could work with in Europe?
Well, I think it's Orban first, and then when Trump realized that Orban actually doesn't have a whole lot of power in the EU, it will be Meloni second.
So when it comes to the tariffs, and if you think they're going to be enacted first, personnel is policy, as you know, in Washington, D.C. Where does he put Lighthizer?
We think Lighthizer could be at USTR. He could go back to USTR. But, if I'm Robert Lighthizer, honestly, I'm looking for a slightly larger portfolio, a little bit of a bigger role, and that could be a commerce.
That's tariffs. Let's talk taxes. Let's talk about what can actually get through Congress and your view on what took place in the Senate in the last 24 hours. How constrained will this presidency be by a Senate that, for some people, stared down the president-elect and made its own decision about going a different way?
Yeah, well, I think we can all be sort of relieved and happy that it's going to be John Thune, who is, to his core, an institutionalist. So to the extent that it's not Rick Scott, John Thune presents a little bit more of a constraint. But, I mean, he's got 53 votes in the Senate, so I don't think it's going to be a huge constraint moving forward.
But Senator Thune has said he will not get rid of the filibuster. So basically, the only thing that the Senate can do with that kind of majority at 53 is tax and budget, correct?
Yeah, totally. We think it'll be a very big budget reconciliation package. They're talking about getting it done in the first 100 days of the term. I think that will be exceedingly difficult. We also have to realize, frankly, that we're running up to a budget cliff in December as well. So they're going to have to pass a CR in the short term with the current Congress. If they pass it out to January, February, they're going to have to deal with that first, larger reconciliation package after that. But there's now talk about extending the CR to September, October, November to give them kind of that first 100 days latitude to get the budget reconciliation deal done.
So with Thune at the helm, what do you make of how the confirmation hearings are going to go?
Well, I think we can safely say, or at least I will predict that Matt Gaetz does not get confirmed as Attorney General. So he may wind up being sort of the sacrificial lamb of the cabinet picks. I think everybody else probably gets through. Again, Trump can lose one or two Republicans in any confirmation vote and still pass his nominees. So, Hegseth probably going to be a longer, more difficult process, just given that he's not really on the books regarding policy at all. I think Matt Gaetz is probably the one who was struck down, and everybody else probably gets through.
Hegseth and Gaetz, though, showed us that Trump is willing to nominate people who hadn't been on anyone's list. I don't think anyone expected either of them to be put up for these jobs. Does that show us that maybe we're too sanguine, that when it comes to Treasury Secretary, we'll get kind of a classic pick, a market-friendly pick?
On Treasury, I mean, I think it's going to be Besson or Lutnick, frankly. So to the extent that sort of hems us in, I think that's good news. But we have to be honest in saying that Trump received whether or not it was a landslide, I think is up for debate, but a national mandate, right? And he's going to put people into these jobs that A, he likes, and B, were very loyal to him. And he's not really going to apologize for it. He doesn't have to apologize for it. He won the national popular vote. He's got a Senate majority. And so do I think we could get more surprises from here, or at least really more Trump accolades from here, whether or not that's a surprise? Yeah, I think we could.
But does Thune's lifting up as leader not show us that there is some resistance to some of Trump's ideas and who he wants?
There is some, I would say there is some resistance, or at least it's clear that the Senate isn't going to just roll over for Trump every single time, right? And I think John Thune he'll be a very good majority leader, he'll be a strong majority leader, and to the extent that he wants or has to stand up to Trump, I think he will be able to. That being said, though, on policy, right, on tax policy, on tariffs, et cetera, I think most of the Republican majorities in Congress are in line with Trump. So Thune is not going to stand up on policy. He may stand up on some of these personnel decisions.
When Trump went to the House the other day, when he also had the meeting with Biden, he brought Musk alongside him. I just wonder what the presence of Musk, who's become this huge donor for the Republican class, does to affect sentiment in Capitol Hill. Is there almost an element where they need to follow the money and that Musk represents a greater threat to them and maybe even funding challengers to those who don't support Trump?
Yeah, well, I think one of the biggest stories over the next 2 years may wind up being Trump and Musk falling out, just because it's two very talented political individuals, two very big egos in the same room together. That only worked for so long, right? So it seems as though Musk is attached to Donald Trump's hip at this point. He's running this government. He has this government efficiency mandate now. We'll see how that goes. Do Republicans want to keep him on sides, at least until the midterms? Definitely. Will Trump be able to? Will keep him on sides and keep it friendly? I honestly think it's easier said than done.
Do you think Democrats could have avoided this if they'd shown as much love to Elon Musk as they had shown to Mary Barra of GM? Could this all have been avoided?
I mean, yes, but I also think that in terms of Trump's, not cabinet, but kind of broader, universe, it was there for the taking from Musk. It was there for the purchasing. And to the extent that Democrats were nice or not to Musk, I think less important because Trump was able to give Musk really what he wanted, and that is power.
John brought up the Democrats. Yesterday, there was a report that the reason why Kamala Harris didn't sit down with Joe Rogan and tap his 15 million subscribers is because they were worried about the progressive pushback. How does the Democratic Party pick up the pieces?
Well, there's going to have to be a reckoning for sure. And obviously, in this global landscape, it's hard for any incumbent administration to get reelected, right? We haven't seen that happen across the board this year. So I certainly think Kamala Harris was running from behind almost from the get-go. That being said, Democrats have sort of installed this message that is incredibly left on social issues and actually pretty moderate on economic issues. And frankly, I think most voters want the opposite, right? They want a populist economic policy. They want an economic policy that's going to lift up manufacturing, lift up the working class, and they want to hear less and less about some of these social issues. And so I think Democrats essentially have to inverse the messages.
The midterms are in 2 years. How do they prepare for that?
In these 2 years, I think it's going to be very hard to turn the party around 180 degrees, right? It's hard to steer a really, really, really big boat with a really, really, really big bureaucracy. That being said, I think for the next 2 years, essentially, they are going to tit for tat against Trump. They're going to be able to run against Trump in the midterms. Most of the time, an incumbent party does not do very well in the midterms, as you all know. I think for Democrats, the bigger issue, the bigger challenge is just what is the proactive, sort of positive message for their Democratic nominee. And it's going to be a major fight. We're going to see 10 to 20 folks in that nominee race. And so the question is, what is the message from the primary that emerges? It's 4 years from now. We just stopped talking about this.
I was going to ask you, have you got a name to watch? Have you got a name in mind?
I think Pritzker from Illinois is sort of my dark horse candidate. Not a DC figure, but he can be, Democrats' billionaire. In relation to Trump, he's tough talking. He's come out post 2024, strongly in favor of many Democratic messages and strongly opposed to Trump. And I think it's a strong figure that's going to have to be at the top of the ticket for Democrats to compete in 2028.
Rob, appreciate it. It's good to see you, sir. Thank you. Rob Casey there of Signum. Weinstein of Morgan Stanley with us around a table. Brian, welcome to the programme. If we get a cut in December, is that the last one?
It's the last one for a while. It could be the last one. I think they take the first quarter off, at least the first two meetings. There's a lot of things that they have to sort through. I think this 100 we had got here was automatic, right? We can all talk about the data and every data point reacting to it, but we didn't. We didn't react to it. The data was stronger, and we used 100 basis points, right? The reaction was 550 was probably too high. 450 sounds more normal. Is it? We'll find out. So I think that's where we are, but I think it's time to watch and let the policy take effect and see what happens.
What concerns you? Is it the current level of things? Are you looking less of the trend and more about the levels and getting concerned that maybe we get stuck around these kind of levels?
I think we get stuck for a little bit. And listen, our investors, speaking with their wallets, are buying fixed income, right? We see it everywhere. The money's coming in. You're getting a decent coupon. It should be a hedge for equities. It hasn't been a great, although now at the back of the highs in yield, the correlation's breaking down a bit, right? Equities are doing okay. So my instinct tells me the trade for next year is that we're going to seek out the higher end of this range. So, call it, 4% to 5.5% maybe for next year. I don't think we get there quickly. If we do, it's a problem. It'll hurt risk. But if we get there, kind of hang out at 4.5%, start to move higher, I think the market will be okay as long as it's a growth story. You have all the debt stories, you have inflation, but I think at the end of the day, the growth story is actually the important one.
I mean, in the meantime, Brian, can you touch duration at all? There are just so many unknowns for 2025, and it's playing out on the long end of the curve.
Yeah, listen, when I look at the yield curve, I say, history is a great guide, right? 2s, 10s in a normal cycle should get to 150, 200 basis points. 10s bonds, let's forget the deficit for a second, just normal times, should get 80 to 100 basis points. I look at the yield curve and go, wow, if 2s are going to be stuck at 4.5, and you make a big gulp, right? If you had 200, you get some big numbers there, right? If that's where we're going. So yeah, I think duration has a place in a portfolio. It always does. And I could be wrong. Yields could fall 100 basis points. So I don't hate it as yields go up. But again, I don't see a reason to rush into it if you believe we're going to go back to normal looking yield curves and you don't think Fed funds is going to go back to 3, right? So there's a lot of variables around it. That's how I look at it.
But that's still not kind of the most comforting for, as you say, something that's usually the haven, usually something that's uncorrelated with equity. So what becomes that in the portfolio?
Well, listen, I think on the front end of the yield curve, you still get you can get good income without the duration. We've seen big flows into floating rate loans, short duration municipals, income funds in fixed income that have less duration and more coupon. So I think you can get coupon without taking max duration risk, is how I would look at it. And again, that's what investors have been buying.
I was saying you were coming on the programme about an hour ago, and I teed up the credit conversation. So let's do it. The spread right now for investment grade credit is like this big, 76 basis points. It's as tight as it ever has been for the whole of this century. I want to understand from you why you think it can get a whole lot tighter from here.
I think it gets tighter from here. I think there are two major reasons. One is the buying dynamic, right? So listen, if I'm right and yields drift higher, there's a lot of government debt. We've covered that. There's less corporate debt relative. So people will continue to buy corporate debt. If the growth story is good, equities do fine. And so credit gets tighter. The second piece I think people don't truly focus on, which is the market structure has changed in the 100 years. How hard was it to trade corporate bonds when I started in this business in the early 2000s? Now you have ETFs, right? You have baskets of bonds trading. Credit is much, much more liquid. So if there's less default risk currently, too much government debt, and it's easy to buy, I would say, again, I would think there's a mathematical limit somewhere around 50 basis points, a little bit less, maybe. That's a pretty aggressive call. So I don't think we have to get there. But I do think in an orderly sell-off, credit will continue to frustrate people and continue to tighten.
Yeah, but your call is so much more aggressive than that, and you're burying the lead. There's the spread. You think this can happen? The Treasury yields could go above what we could see in corporate America, maybe not across the whole index, but perhaps possibly on a few credits.
Well, there's so few high-rated credits, right? The other century change is that the BBB part of the index is so much larger. So I don't think you have BBBs trading through government bonds. But for those few companies that can trade with an A, I do think there'll be a select few, some of them are really close right now, to go through government bonds. Do I think it's logical? No, the government can print currency, right? It's a better credit. But I think it's a supply-demand dynamic. And listen, you can make an argument that if you have fiscal irresponsibility, that maybe I'm wrong. Maybe they should trade through. So I think they will in certain credits, and I do think credit tights are not. We have not seen them yet.
Well, corporate credit is one of those markets that people look to get a signal for overall health. That okay, if spreads start to blow out, then I need to get worried. You mentioned the ETFs, but I also just wonder how much of this is just a really distorted risk premium. Not even with ETFs, but all the risky stuff is starting to go to private credit now. Can we really use corporate credit as a signal anymore, as in the way it once was?
It's a fair question. Listen, you're right. A lot of the risk has moved to private balance sheets, doesn't get marked to market. Does that leave higher quality or lower quality stuff for the public markets? We can debate. I think the investment grade credit market is a little less affected by it. So I do think it's a kind of a chicken and egg question, right? If the equity market goes down 20%, or there's credit going to be wider? Of course. Will it be caused by the credit market? I don't know this time around. Again, I think investors are happy to buy the extra spread and the yield you get from treasuries plus corporates. And I think there's some logic to be said. I don't need to own treasuries. There's not a lot of upside to doing so. Your duration question earlier. So again, we're tight. Credit spreads are tight. I think they'll get tighter. Listen, if it gets disorderly, if 10-year notes are 5.5% in 6 weeks, it'll be a different story. But if it moves in an orderly fashion, I think that's where we're going.
Brian, we're going to hear from Jay Powell today, and you started the conversation saying that December might be the last cut, and maybe no cuts next year. Could we see hikes next year?
Listen, it's fun to talk about. I don't have I don't think I could sit here and lay out for you exactly how we get there. In other words, if inflation runs 0.2 to 0.3 instead of going back to 2, is the Fed going to go right back to hiking? I don't think so. So I think it's possible. I think it's more likely that they just want to sit here and let the government do the work. That they can say, listen, maybe we'll say 4.5% looks more like neutral than we thought. Right? Could it be 4? Sure. I still don't think it's 5. So hikes would require all of these things to happen, tariffs be super inflationary, but still pro-growth, and equities making new highs again. It would be. I could tell you this story, but I don't sit here thinking about rate. I don't want to bet on a rate hike in September as my base case.
You don't want that to be the headline, Brian. No. Don't worry, it won't be. It'll be something else on credit. Brian Weinstein there of Morgan Stanley. Brian, appreciate the update, sir.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.